Ever wondered if there's a single number that can tell you how healthy a company's day-to-day operations are? Kind of like a financial heartbeat monitor? Welp, there is. It's called the working capital turnover ratio. And today, we're going to dive deep into what it is, how it works, and what secrets it can tell us. Every single business on the planet faces this one fundamental question. Are you actually using the cash you have on hand, your day-to-day money, to make more money, to generate sales? Or is that capital just sitting there, not really doing much of anything? That's the core challenge. And the answer to that question? It's right here, in the working capital turnover ratio. Honestly, the best way to picture this is to think of the RPM gauge in your car. It's not telling you how fast you're going, but it tells you exactly how hard that engine is working. This ratio does the exact same thing for a company's financial engine. Okay, so let's pop the hood here and see what's going on inside. First things first, we're going to break down how you actually calculate this thing. And trust me, it is way simpler than it sounds. It's really just a three-step dance. First, you figure out the average working capital. Second, you find the net sales from that same time frame. And third, you just divide the sales by the capital. That's it. So let's look at those two main ingredients. So the top number in our little formula is net sales. And the word net here is absolutely crucial. We're not interested in the big, flashy, gross sales number. We want the real number, the money the company actually gets to keep after people return stuff or use discounts, right? If a store sells $1 million worth of jackets but gets half of them returned, their net sales are only $500,000. That's the honest number we need. And on the bottom of the formula, we have average working capital. Now, working capital is just the cash a company has tied up in its daily grind. Think inventory and cash minus the bills it has to pay soon. But again, the key word here is average. We don't just want a snapshot from one day. Why not? Because a company's cash situation can swing wildly. Maybe they just got a huge shipment of inventory the day before they close the books. That would totally skew the results. By taking an average, we smooth out those peaks and valleys and get a much truer sense of what they were working with all year long. So you run the numbers, and you get something that looks like this, 4.21x. Now, this isn't just some random number. It tells you a really powerful story. It means that for every single dollar this company invested in its daily operations, it generated $4.21 in sales. It's that direct link between the money they put in and the revenue they get out. All right, so we've got our number, but what does it mean? Is 4.21x good, bad? Let's get into the interpretation and figure out what a high or a low ratio is really telling us. Generally speaking, a high ratio is what you want to see. It's a huge green flag. It tells you this is a lean, efficient operation. The management team is squeezing every last drop of sales out of each dollar. This usually means they aren't letting inventory pile up, and they're collecting their cash from customers super fast. A low ratio, on the other hand, that's a red flag. It points to inefficiency, what analysts call capital drag. It means too much money is just sitting around, locked up in unsold products or waiting for customers to pay their bills. Okay, so it seems pretty simple, right? Just get the highest number possible. But, in finance, nothing is ever quite that easy. There's a really important catch we need to talk about. See, if the ratio is extremely high, it can actually be a warning sign. It might mean the company is running way too lean. They have so little capital and inventory tied up that they're constantly at risk of running out of stock. If a big wave of customers suddenly shows up, they can't meet the demand. So yeah, they look efficient on paper, but they might be leaving a ton of money on the table. And that brings us to probably the single most important rule in all of finance. Context is king. A number all by itself is pretty much useless. To know if that 4.21x is amazing or terrible or just okay, we absolutely need context. And just look at this. The differences between industries are absolutely massive. A software company with basically zero physical inventory might have a ratio of 20 or even higher. But a construction company, which has to buy tons of materials up front, a ratio between 3 and 7 might be perfectly healthy. You just can't compare the two. It's apples and oranges. So look at this chart. A ratio of 6x for that construction firm would be fantastic. You'd say, wow, this team is really managing their capital well. But that exact same number, 6x, for a tech company or a big retailer, that would be a sign of a full-blown crisis. The only comparison that matters is how a company stacks up against its direct competitors and how it's been doing over time. Okay, so now it's time for the advanced class. Because, like any financial tool, this ratio has some hidden traps and blind spots. If you're not careful, it can definitely lead you astray. This is probably the biggest blind spot of all. This ratio is built on something called accrual accounting. That means the net sales number includes sales that were made on credit. So a company could have this amazing, super high turnover ratio, but if none of its customers are actually paying their bills, that company is driving straight towards a cash crisis. Remember, it measures the efficiency of generating sales, not the efficiency of collecting cash. Big difference. And this is where it gets really sneaky. A simple choice in accounting methods can totally change the result. When prices are rising, if a company uses the FIFO method, its inventory looks more valuable. That makes its working capital bigger, which artificially pushes the turnover ratio down. But if they use LIFO, the opposite happens. It pushes the ratio up. You could have two identical companies that look totally different just because of a choice their accountants made. And there's more to watch out for. Some companies, like big grocery stores, actually operate with negative working capital, which is a sign of incredible efficiency. But for them, the formula just breaks and gives you a meaningless negative number. The ratio can also get thrown off by seasonality, and this is a big one. It tells you absolutely nothing about a company's long-term debt. It's a snapshot of operational efficiency, not total financial strength. So with all these potential traps, how do the pros actually use this thing? Well, the secret is they never look at it by itself. So for our final section, let's see how they combine it with other metrics to build a truly complete picture. The key is to always pair the working capital turnover ratio with its best friend, its conceptual partner, the cash conversion cycle, or CCC for short. Think of them as two sides of the same efficiency coin. You really need to look at both. This slide just lays it out perfectly. The turnover ratio, the one we've been talking about, it measures magnitude. It answers the question, how much revenue are we getting for each dollar we put in? But the cash conversion cycle measures time. It asks, how many days is that dollar tied up before we get it back as cash? One is about power, the other is about speed. And this right here is the holy grail. This is the gold standard of operational excellence. You want a high working capital turnover, meaning your money is working incredibly hard for you, and you want that combined with a short cash conversion cycle, meaning you get that money back super, super fast. Any company that can pull off both is a true master of its craft. So at the end of the day, the working capital turnover ratio is so much more than just a number you calculate. Once you really understand what goes into it, once you see it in its proper context, and once you know its limitations, it stops being a formula. It becomes a story about the rhythm, the efficiency, and the very health of a company's operational heartbeat.